But let's invite our guest for the morning, Anurag Singh, the Managing Director of Ansid Capital, joins us now. Anurag, good morning, and thank you very much indeed for spending time for us in a Christmas weekend. That's very kind of you. Well, for starters, the dollar index seems to have cooled down after a fiery last 4 days. It is at its Thursday lows. Can we count on the week at least being placid and Asian markets beginning to gain back some green?
Yeah, Latha, morning. First of all, I'm getting a bit nervous because, with the extent of knowledge you have on economics, I can't really challenge your ideas much, right? But I'll still try. So, Latha, the direction is that Europe, nobody wants to go long Europe, right? And if China is mixed and Japan is mixed. I think out there's only one place to invest money internationally, which is US. So overall, collectively, money is chasing US dollar, and why not, with a 4.5% yield. And now that it appears that Federal Reserve is going to be cutting maybe one or two next year. Two is what they're saying. Market is pricing maybe one. So yeah, difficult, right? Because look at right from 2008. Here is my broad thesis. Right from 2008 till 2020, the FII holding of Indian stocks really jumped from like 8, 10, 12% to then 22% peak. And ever since it has been dropping right now to 16, 17%. I would not be surprised if it comes down to around 11, 12% if this continues for another couple of years. But I think that should be okay because markets don't really need domestic flows. The FII flow. Indian markets at least don't really need that, right? So yeah, that seems to be the call, right? If you can earn risk-free, you were talking about it. If you can earn risk-free, why would you take a currency risk to earn just about 3-4% more in the emerging markets or Europe or rest of the world?
Okay. The issue here for us in India has been this absolutely relentless FPI selling, right? We've been discussing this for a while. The buy America, the go home trade. It's been the hallmark of, I think, since October, November, December. Do you see that changing anytime soon?
So, Surabhi, there are 2-3 takes here. One is look at the last 10 years. The collective emerging, I understand it's a basket, right? But collective emerging market as a basket, MSCI index is barely like 3%, right? That's one call. So eventually, if that 10% money is lying into emerging markets, the call is, well, for the last 10 years, either the China works, then India doesn't work, India works, China doesn't work, or collectively, if all of them work, then Brazil or, rest of the world doesn't work. So the point is now there is a new judgment coming in, which is that, well, if you're holding a McDonald's, if you're holding a Starbucks, if you're holding Apple, Microsoft, Google, all of these companies have about 30 to 40 to 50% earnings coming from rest of the world. So even holding these companies within US is a diversification for the rest of the world, right? That is one thinking, right? That's one trade. Second is, of course, everybody chases the past returns. Last 10 years has not been great if you have been either in your long Europe or long emerging markets, right? So that's the other play. And third is, it's free money. Capital will move towards whichever market shows most promise. So I think the confluence of all these factors really is playing out in terms of just parking money within US plus strong dollar, right? So all these things combine, I think, Surabhi, we need to have we need to be cognizant that at least this headwind for emerging markets is going to last at least for 1.5 years more. But I'll add 2 more points here, right? This FII selling is a bit of a distraction within Indian market, right? I think the focus should be when a Flipkart says they were planning to list in NYSE or NASDAQ, right? But now the plan seems to be changed. Now they're wanting to list in India. LG now is coming up planning to list in India. Hyundai takes away $3 billion. I think those are more pertinent and larger questions that we should raise. Look, FII money anyways was a short-term money, right? It'll come back again, right? If the right valuations are there or the dollar eases off, 10-year yield eases off, it'll come back. But this is the money that's being really taken out. This is where something I think we need to watch out for, right? Yeah. Can I add, just out of interest and just because, and this goes to Latha, we all the time we say Indian market cap is now 5 trillion, and UK market cap is barely like $3 trillion, right? It's not an apple to apple comparison. United Kingdom allows free flow of money. So if you are sitting in UK pension funds have 20% of their money invested in US markets, only 4% invested in United Kingdom market. So that's a free flow of money. India doesn't allow that. And that's why the same domestic money is just trapped and it keeps overvaluing the assets within the Indian market, right? So that seems to be the challenge with the Indian space. It's not.
Your point is taken on value. There is still so much of overvaluation concerns, but I think Reema has a question.
Yeah, just to put a number on the IPO frenzy, this year Indian markets have seen a record fundraise of 1.6 lakh crore rupees via IPOs. So it's a big milestone, and even the size of the IPOs has gone up, the likes of Hyundai, etc. So Anurag, just elaborate a little bit more on the point that emerging markets are headwinded for the next 1 to 1.5 years. Are we in for a correction? And in the emerging market basket, what would your pecking order be? Because this year too, year to date, while we all thought that India is the best game in town, we're up 10% year to date, 2024. But a Hang Seng, Nikkei, even a Shanghai, they all have outperformed India with a gain of 15-16%.
Yeah. So Reema, India is still the best game in town, right? Outside of US, correct? There is this is I think last 6 months I've been hearing India chatter in almost in almost every group. Even the people who are not talking about it now talking about India ETF and India, so there is a lot of interest, right? And partly because they understand that there are strong exits available, right? So you can get in, get out. There is this ease. It's not as shallow a market as it used to be, right? But I think in terms of the market potential, right? I think Nifty is great, right? There's no challenge on Nifty. The long-term returns, 30-year return is CAGR is 12%. Last 5-year CAGR is just about 12, 13, 14%. So it's broadly in line, right? So Nifty is fine. I think the only correction needed is, and maybe this is a bit of my thesis, Reema. I looked at Nifty 500. Look, it's hard to look at the mid and small separately because the composition has been changing. But if you look at Nifty 500 right from inception, the returns were around 10%, 9.9, 10% till 2019. It's only for the last 5 years we've got a 30% CAGR on mid and small caps that Nifty 500 has also come equal to Nifty 50. I think that needs to, it needs a bit of a mean reversion. And when that happens, it'll lose about 1.5%, which means maybe a 20% correction from here only on the Nifty 500. So it goes down from, say, maybe 23,000 to maybe 19,000. That's the only segment which is overvalued, and that's the only segment where FIIs don't have any play. So it's only domestic money just, valuing it. Otherwise, Nifty is great. I think it's exactly where it should be on the long-term potential. It's absolutely fine.
Okay, Anurag, thank you very much for joining us today with your insight.